Hello traders, this is Fawad Razak, the market analyst for City Index. Today is the 15th of February 2024. So we're looking at the dollar index today after the disappointing retail sales data caused the greenback to weaken a little bit, which I don't think was a game changer because we are still seeing signs of elevated inflation as indicated, for example, by rising input costs, which came in at its highest level since I think it was March of 2022. That comes hot on the heels of the CPI report that we saw on Tuesday, which caused the dollar to rally before the dollar weakened in the last couple of days. But now it's testing this key support area, as you can see on this daily time frame. This area was previously resistance back in December and a couple of more times in recent trade before we broke above it. Now it's coming back down to retest it from above. So from a technical point of view, at least, we should see the dollar push back up from here. However, the line in the sand for me is this week's low at 103.90. Should we break below that, I think at that point we'll have to drop our bullish view on the dollar. Looking at the dollar yen here, it's showing a similar picture as the dollar index in that it is also testing a key support area in the shaded blue area around 149.50, which was previously resistance before we broke out earlier this week in response to that CPI report. So this area is very important. I think if it holds here, there's a good chance we could see new highs for the year and a potential breakout above the highs that were hit in the last couple of years at around 151.95 back in October here. And there was another high just above it I think that one was in 2022. Anyway, it's a double top, so I think there's going to be lots of stops resting above it. I think the dollar yen is going to head and probe liquidity there in the next few days. First things first, the short-term resistance level to watch is Wednesday's low at 150.35, this line here. Should we break above that level, then liquidity above this week's earlier high would be the next target for the bulls. Like the dollar index, I think a break below this week's earlier low at 148.90-ish would invalidate this bullish technical setup. The euro dollar is higher at the moment following hawkish comments from ECB President Lagarde and on the back of those disappointing retail sales data from the US. However, the trend is bearish, and given the fact that we are looking at a bearish trend in that price has been making lower lows and lower highs, I wouldn't be surprised if this bounce fades as we head deeper into the US session and into the week. So resistance, in my view, comes in at around 107.55 to 108 area, where previously the euro dollar had found support before breaking down. And 108 is very important because that's where it sold off from on the back of that strong CPI report from the US. So that is now a significant support level to watch in so far as the short term is concerned. And for as long as we hold below it, I think the path of least resistance will remain to the downside. If, however, we break above 108 on a daily closing basis, then that could potentially pave the way for a sharp short squeeze rally towards the previous high that was created at around 108.95. But we'll cross that bridge if and when we get there. So 108 is the key level of resistance to watch on the upside. On the downside, we've already broken the December low. That was the main bearish objective for us. So in a way, it's kind of in a neutral area now. You know, if the bearish trend resumes, 106.70 is the next downside target that we are eyeing. Below that, 105.80, the head of this hammer candle. And then finally, 105 is the long-term support level that we could see the euro head down to. Looking at the chart of gold here, prices have been weakening in recent weeks because of the renewed strength in bond yields and a strengthening US dollar. Gold is back up today, along with all the major FX pairs, but it is testing key resistance here. So I wouldn't be surprised if it were to resume lower from here in light of the hot inflation report we saw on Tuesday. The resistance level to watch is between 2000 to 2015, the shaded area, where it had previously found support, and it's now testing that area as potential resistance. So it's possible that we could see gold head lower from here and probe liquidity below this low, which was the December low at 1973. I think that's going to be the next downside target for gold. And below that, we have the 200-day moving average coming in at 1965. So there's going to be some interesting levels to monitor on the downside should we get to those levels. The key area below the 200-day is the shaded blue region, where the 61.8% Fibonacci retracement level converges with prior support and resistance. For more market analysis and insights, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.